You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Cantrell. The banking landscape normalized further in 2025 after years of rapid macroeconomic adjustments. Banks start 2026 with a positively shaped yield curve and steady deposit growth, but there's still sustained uncertainty regarding the economic outlook and the future path for Fed policy. On today's episode, we talk with FHN Financial's Jon Cantrell and S.J. Guzzo about this year's banking environment for deposits and loans, how banks can position themselves for different yield curve scenarios, and the most important regulatory changes in the year ahead. One final note, we recorded this conversation in late December, so any mentions of this year and next year were referring to 2025 and 2026 respectively. Coming up soon, our interview with Jon Cantrell and S.J. Guzzo, but first, a quick market update. The December employment report this morning showed private payrolls grew 37,000 last month, and the unemployment rate fell to 4.375%. The Treasury market surprisingly rallied despite the first fall in the unemployment rate since the summer. Yields have been rising earlier in the morning, so traders were probably already positioned for a strong print, but the report is also the first set of clean data since September because of the government shutdown, so there's probably some broad skepticism. The U.S. ousted Venezuelan leader Nicolas Maduro last weekend in a swift operation that brought him to face criminal charges in New York. The financial market response has thus far been muted, but there is still a risk of further instability in Venezuela and tensions escalating worldwide. The minutes for the December FOMC meeting were released last week and showed an unsurprising divide between Fed officials who supported a rate cut and those who preferred a more patient approach. Some participants also believe policy is at or near the neutral rate and do not want to make financial conditions any more accommodative while inflation is at 3%, something Minneapolis Fed President Neel Kashkari expressed in a public appearance earlier this week. The minutes also walked through the Fed's thought process for its new reserve management purchases, or RMPs. At the October meeting, the FOMC announced it would soon consider purchasing treasuries to alleviate pressure in short-term funding markets. Money market indicators like SOFR and the effective Fed funds rate were showing enough evidence of distress by last month's meeting that the Fed would begin buying treasuries with maturities of less than 3 years only 2 days later. FOMC participants felt it was best to front-load the purchases to minimize the risk around typical periods of high liquidity demand, like the end of the year and the mid-April tax deadline. Also, as we record this on the morning of Friday, January 9th, the Supreme Court is set to announce possible opinions at 10 a.m. Eastern Time, which may include a ruling on whether President Trump unlawfully implemented many of last year's tariffs using emergency powers. That's all for the market update this time. Now our interview with Jon Cantrell and S.J. Guzzo. We have two guests for today's episode. Jon Cantrell, Head of Portfolio Strategies with FHN Financial. Jon, thanks for joining.
Thank you, Will. Happy to be here.
And S.J. Guzzo, Senior Portfolio Strategist with FHN Financial. S.J., thanks for coming on.
Absolutely. Thanks, Will.
Our topic today is the banking sector in 2026, how banks are positioning themselves given the current interest rate environment and where we are in the economic cycle. So, Jon, I want to start with a question about deposit growth for banks. The regional banking crisis caused big deposit outflows a couple years ago, but we've still seen growing deposits in money market funds. So now that the Fed funds rate has come down 175 basis points from its peak this cycle, do banks feel good about their deposit growth? Are there any lingering risks to deposit outflows, you think, going into 2026?
Yeah, thanks, Will. So deposit trends have certainly been a headwind to margins over the past few years, but that's changing. There's no question about it. We feel like banks should continue to have opportunities to reprice their deposit base lower and hopefully grow deposits at the same time heading into next year. We're seeing a very favorable environment right now with a combination of lower rates in the short end of the yield curve, expectations for at least 2 more Fed cuts. Some certainly have more than 2 cuts priced in, depending on who may be the next Fed chair. And then finally, the relatively short-term structure of time deposits for most folks. According to a fairly recent Bloomberg survey, this was several months ago, an overwhelming majority of 81% of respondents forecast deposit growth over the next 12 months. An increased proportion of respondents expect small business and wholesale broker deposits to contract over the next year. And then finally, deposit competition is expected to rise in their respective market areas over the next 6 months. So it sounds like most expect deposit growth along with stout competition and also a changing deposit mix. Really, the challenge going forward is going to be to grow and defend deposits without simply paying up for them. It's no longer about just who pays the most, but I think who understands the most about their customer. We feel like the banks that win in 2026 are likely the ones who are going to treat deposits not just as balances, but as relationships. Added to that, also the ones who really begin to rebuild their deposit franchises through things like product innovation, marketing creativity, and things like that. Again, not strictly a focus on rates. I think product simplification is going to be important. Data-driven segmentation is going to be important instead of simply treating all deposits as equal. Offers tailored by customer type and things like that. We're also seeing a number of banks that are now using AI to really understand client behavior at a much more granular level. For instance, how money moves between accounts, which channels customers use, and really most importantly, what patterns precede either deposit attrition or deposit growth. This really can allow a bank to act before money walks out the door. As far as risks to deposit outflows, some of these are ever present, some are fairly new. I would say starting with a shifting focus. Again, it's not just going to be about rates. It will also be about things like digital tools and features, perceived safety, things like that. There's also the fintech threat, which is one of those that seems to be kind of an ever-present risk to bank deposit growth these days. Rate sensitivity, of course, even though that's not going to be the only deciding factor, as we've discussed. And then finally, a lack of AI adoption resulting in basically outdated legacy type systems. Banking technology is really evolving quickly, and you really can't afford to get left behind in the race to effectively use that data. That said, AI is certainly empowering customers to find better rates, and not just to find better rates, but to do it very quickly and very efficiently. I kind of view AI in the deposit rates as a bit of a double-edged sword. It's difficult to live without it, but it also certainly creates some new challenges. Summing that up, I think overall we can expect continued deposit growth and favorable repricing heading into 2026, but there's a fair number of caveats to that.
Yeah, it sounds like the tone is maybe the same as most macroeconomic outlooks, which is cautious optimism that we're going to continue to be on the glide path we've seen over the last couple years. But we've always felt like we're in this delicate balance and we're on a knife's edge and maybe something could turn soon. But the baseline expectation is that things continue to go the right way. SJ, I want to move on to another bread and butter aspect of banking activity, which is loan demand. So as we said, interest rates have come down, but it feels like a lot of people spent 2025 cautiously waiting to see how the economy would respond to some big policy shocks. So what did loan demand look like in 2025? And do you think demand in 2026 will be more tied to how the economy evolves or the path of Fed policy?
Well, there certainly were some big shocks in 2025, that's for sure. But I think loan demand was strong throughout the year. Coincident, and I think it goes to follow the strong earnings that banks put up. From the reports that I've read, it's up about 5% year over year. So that's a strong showing. It's generally broad-based across the loan portfolio. Highlights being in 1 to 4 family and maybe some CRE areas, but generally broad-based across the portfolio. There has been a focus on credit. Many were waiting for credit to become an issue, but up to this point, it seems to have held in relatively well. That doesn't mean, though, that institutions haven't been focused on it. They're very focused on it, I think, but prudently. without really significantly tightening standards, but just making sure that they put themselves in a situation where credit is monitored and is less likely to go wrong for them. For 2026, my expectation is that loan demand is somewhat more moderate than 2025. Consumer sentiment is a little bit lower, maybe, with the focus on affordability recently. Business confidence a little more restrained as they continue to work through the impact or the potential impact of tariffs. And whether loan growth is more dependent on interest rates or the economy, I think it's going to be a little bit of both. The continued evolution of the economy, including those sweeping changes around like a new tariff system. And frankly, let's not forget about the case in front of the Supreme Court that may throw tariffs out, and whatever the impending chaos that might ensue after that causes some uncertainty. But the Fed seems to be keeping an eye on both inflation and the labor market. Lately, maybe leaning a little more heavily toward the labor market. It seems like we'll get those two cuts that John was talking about. So that may be an offset to some of those other headwinds. And that might help loan demand in the back half of 26.
The yield curve is back to being normal or steep after quite a while of being inverted this cycle. Things have stabilized a bit depending on how you measure the steepness. The spread between yields on 2s and 10s, for example, has really steadied since the middle of this year, but it's still not all that steep by historical standards. So, John, what are banks expecting for the shape of the yield curve next year?
The 2s, 10s portion of the yield curve gets the most press, and this is also where most of our bank customers focus when discussing the yield curve. 2s, 10s are currently positive by around 65 basis points, give or take, which is the steepest this portion of the curve has been since Jan of 22. And let's not forget the yield curve finally turned positive, to your point, Will, in September of 24 after the longest inversion in history. We're certainly not steep, but at least we have a positively sloped curve to work with. As far as what banks are expecting going forward, I would say the majority of the banks that I work with, and I think it's fair to say that the majority of the banks that FHN does business with, are expecting the curve to steepen further in 2026 as the Fed continues to cut rates. I would say most seem to expect a bull steepener based on my conversations, meaning both the yield on the 2-year Treasury and the yield on the 10-year Treasury fall, but the yield on the 2-year Treasury falls more than the yield on the 10-year. That said, I have had some recent conversations with bank customers who also expect the yield on the 2-year to fall, but they're expecting the yield on the 10-year to rise, whether it's due to inflation, fiscal deficits, or maybe both. Either way, whether bull or bear, I think most banks have a steepener bias, and most of our customers have acted accordingly with regards to their fixed income investments this year. There aren't very many conversations occurring around a flattening of the yield curve in 26, given the current economic backdrop and really the probable path of the Fed going forward. I think it's also worth noting that the most recent Bloomberg survey of economists and strategists, and for those of you who may have a Bloomberg, the page is BYFC. This page also shows continued curve steepening with the 2s, 10s portion of the curve ending next year at around plus 80 basis points. So about 14, 15 basis points steeper than current levels. Again, most of the potential steepening is attributed to the yield on the 2-year Treasury moving lower as the Fed continues to cut rates. So a steepener bias, most of the analysis that we've been running on both single securities as well as at the portfolio level are in the context of that steepening, but I don't think we can completely disregard the potential flattening of the curve next year.
So, John, I want to follow up on that last point. As unlikely as curve flattening feels right now, is there a good way for banks to position against that risk? I do agree there's a general sense that the curve is going to continue steepening next year, or at least maintain its current steepness. But what should banks do to help position against that risk of potential curve flattening?
Curve flattening, I mean, it definitely feels unlikely at this point, but I think we've all learned to expect the unexpected, right? Or at least not to ignore or disregard the unexpected. I just read an article this morning that said Morgan Stanley's top surprise for 2026 includes a bull flattening of the yield curve. Perhaps some are starting to kind of move away from the consensus around steepening. I think in order to talk flatteners in 2026, you have to talk recession. Recession worries peaked shortly after Liberation Day in April. That's when President Trump unveiled the tariffs. And there was a Bloomberg survey at the time that showed chances of a downturn doubling from 20 to 40%. Currently, that same Bloomberg survey shows around a 30% chance of a recession in the next 12 months. But there are some, like Moody's, for example, that are certainly more bearish, putting the odds of a recession closer to 50%. As far as positioning for a flattener, there's really a couple things I would say. First and foremost, from a portfolio strategies perspective, we always prefer a balanced approach. That's kind of at our core. Depository investors aren't traders, right? So most of our clients have a medium to long-term view when it comes to investing, while many, I would say probably most of our bank clients continue to have that steepening bias. They haven't gone all in on that theme. They've certainly skewed purchases towards a steepening bias, that's fair to say, but they haven't gone all in. The second thing I would say is, and this is also very important, the majority of our bank portfolios are still littered with what I call pandemic era bonds with extremely low coupons. So I think to varying degrees, many of our bank clients are kind of already prepared for a flattener, especially a bull flattener, despite executing, in some cases, fairly significant loss trades that have cleared out some of those very low coupon pandemic bonds. For those who still kind of need to address the risk of a bull flattener, I would say from a very high level, I would suggest seasoned paper, deep discount paper, positively convex paper in kind of that, call it 4 to 7 year part of the curve.
So you brought up those losses that we saw that really culminated in the regional banking crisis in the spring of 2023, where there were a lot of big losses tied to the long-term securities that lost value from the Fed's rapid rate hikes. So SJ, how do banks feel about buying duration at this point? After experiencing those steep losses, getting burned, have they regained confidence in those returns, or is there still some psychological scarring? Do banks feel ready to take the kind of plunge into investing into duration, or are they still a little gun shy?
Well, I would say they are careful, but they're definitely open to the discussion. We've had opportunities to get in front of a lot of institutions, many of our clients, and all of them are willing to have the conversation about reaching out the curve a little bit. We talked about before, it's a long time before they forget what happened during COVID, flush with cash, generationally low interest rates, riding those rates back up as the Fed raised 500 plus points in 15 months and then being stuck with those losses and low portfolio yields. And in many cases, we still see those yields in customer portfolios. That's why I've said they need to feel good about the Fed's intentions regarding the direction of interest rates in order to begin to extend. In late 24, many thought we were on our way. You mentioned that little stop and start that we had. They thought that we were on our way. It turned out we were actually not headed in the direction that we thought. We had to wait a little while longer. And that may have exacerbated an already cautious situation, creating maybe a little more uncertainty in the minds of bankers as they wanted that direction from the Fed, but they didn't quite get it. And they needed a little more time to consider buying duration or reaching out the curve. However, 2025 has been a good year of profitability, and perhaps now they're getting that feeling from the Fed that the direction is more likely lower than status quo or higher. And that has begun, I think, to allow them to consider duration. But as I said at the beginning, I think cautiously.
A couple things happened this year that I think would be favorable to mergers and acquisitions. We have seen the Fed cut rates another 75 basis points, and also there is a new occupant in the White House that is seen as more friendly to M&A. So, John, what was the environment in 2025 for M&A, and what do you think it looks like in 2026?
As expected, bank M&A really surged this year. And to your point, it was certainly driven in large part by a much more favorable regulatory environment with this new administration, but also easing economic uncertainty played a role. There were strategic needs for scale and for market expansion. Technology, especially on the AI front, played a role. And then finally, I think the hunt for low cost deposits. There was also a lot of pent up demand to start the year, a lot of dry powder, if you will, based on a much less favorable environment for the last few years. Year to date, there have been 165 deals totaling approximately 46 billion in total deal value. If we compare that to the last couple of years, there were 125 deals in 2024 totaling 16.3 billion and 96 deals in 2023 totaling just 4.1 billion. That was by far the lowest total deal value since 1990. The M&A front is certainly improving and it's been surging this year, but it's also a pretty low bar comparing it to the last couple of years. Some of the more notable deals this year have included Capital One's acquisition of Discover back in May, also the combination of Synovus and Pinnacle Financial. There was Huntington's acquisitions of both Veritex and Cadence, Fifth Third's acquisition of Comerica, and also PNC's acquisition of First Bank, just to name a few. Obviously, there were many more than that. Those were the ones that really kind of hit the headlines. Again, overall, a very strong year. However, we did see M&A activity slow considerably in November, but that was after reaching its highest deal value peak in over 6 years during October. In November, we saw 11 bank deal announcements with a combined 6.4 billion of assets sold. That was actually the second lowest November for total assets sold since 2015. So a very strong year. M&A activity has certainly slowed as we head into year end. There is an interesting data point, I think for some anyway, some won't appreciate this, but credit union bank deals are on track to finish the year very strong. There have been 16 announced credit union bank transactions so far in 2025. 2024 was the all-time high at 19 credit union bank deals. So just a little tidbit there. I do think it's worth noting, and we've talked a bit about this already, many of the recent securities portfolio restructurings are tied to M&A. They're tied to banks that have completed mergers. It's been a big theme this year. Of the 17 publicly traded U.S. banks that mentioned these types of securities restructurings during their second quarter earnings call, 9 of those have completed a bank deal this year, and 2 others announced deals in the third quarter. The banks have often described this repositioning as part of the post-merger cleanup process, which, at a high level, really includes selling those very low-yielding pandemic-era type bonds and reinvesting into current market yields in order to improve margins going forward. And S.J.'s mentioned that. Some also use the proceeds to pay down borrowings. And to be clear, it's not just the publicly traded banks. It's also community banks, really, of all shapes and sizes. So it's been a great year for M&A. I would say unless there is a really notable macro shift or something highly unexpected on the regulatory front, we feel like bank consolidation will almost certainly remain a major trend again in 2026 and probably beyond.
On that note, I know the regulatory environment for M&A changed this year, but a lot of regulations that I think are important to the banking sector happen really slowly, right? So the Basel III endgame debate and everything, that was in the wake of the financial crisis, and we were still talking about it this year. So I want to close out with a question for S.J. about the regulatory changes that might be coming on the horizon. Is there anything that banks should have on their radars in 2026, or have a lot of the changes that are most important already taken place in 2025?
I think there are probably a few things that they ought to be focused on. I think you're right. They have taken place slowly, but I think there are some areas that they need to be looking at. There's been a lot written about the current administration's plans to reduce the regulatory burden. And we can debate whether each and every one of those individual steps are right or wrong, but we find ourselves today in a place where decisions are made based on the cost of incremental regulation like crossing that $10 billion barrier or crossing that $100 billion barrier, rather than really what makes business sense. So if we can get back to an environment where we're making our decisions kind of based on business sense, maybe it's a better place to be. So some of the ideas that have been floated, I think, are probably good to get us into a place closer to that. Scaling some of the asset thresholds that currently drive reporting requirements. That might be a way to help us get there. Implementing a tailored review approach. I think that's an important way to streamline the review process and lessen the burden on institutions. Managing the burden while still maintaining the proper oversight becomes the challenge. But as long as we can do that, I think that's the direction that we probably should be heading. There's buzz around stable coins and crypto and banking. That's an area to keep an eye on. The largest banks are already on their way to payment stable coins and tokenization. So there's something there to watch for. Jon just talked about M&A regulation. Changes in M&A regulation could improve the approval process, make it quicker, and improve the competitive analysis as part of that process. There's AI regulation that is evolving, and there's an awful lot out there, but it's probably a place to keep your eye on. Definitely an evolving topic and something to be mindful of. On the other hand, there's regulatory change like eliminating the CFPB. That's an ongoing conversation kind of tied up in litigation right now. And that it seems to me, might leave a giant vacuum. So being focused on that and how that vacuum might be filled feels like something that institutions ought to be watching as well. Overall, I think the process of regulatory change, it could play out as quickly as this administration can make it happen, but there's always the inevitable court challenges and lawsuits that'll slow that down a little bit. But there are plenty places, I think, for institutions to keep their eyes on in 26.
Jon Cantrell and S.J. Guzzo, thanks for coming on the podcast.
Thank you, Will.
Thank you, Will.
That was FHN Financial's Jon Cantrell and S.J. Guzzo. I think what that conversation really shows is how much steadier conditions are for banks heading into 2026 compared with the last several years. There's of course no guarantee that there won't be a recession this year or that interest rates can't move in unexpected ways, but banks are in a much better position to weather those surprises and stay profitable. The December CPI next Wednesday is expected to show 0.3% increases in both the headline and core indexes. The government shutdown significantly distorted the November report by truncating the month's data collection and preventing any collection in October. Some of these issues will carry through to CPI reports the rest of this year, so investors will most likely view next week's data with a large grain of salt. Also next week, November retail spending is expected to grow 0.4% in the headline and control group series. Because of incomplete price data during the government shutdown, investors won't know how much of any increase in retail spending was because of higher prices, again suggesting a cautious market response to any data surprises. The following week, we'll see November PCE data for personal spending, income, and inflation. The BEA and Census Bureau are still catching up on their delayed economic data releases, so they could announce additional publications at any time. As a result, it's unclear what the full data slate available to the Fed will be at their January 29th meeting. A handful of Fed speakers are on the calendar next week, and we expect more to pop up as time goes on. The Fed's customary pre-meeting communications blackout begins at the end of next week on January 17th. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.